Welcome to our Savvy series. I'm Catherine Magana here with Rachel Ivanovich. And we want to start off with, if you'd like to give us a call or if you'd like to set up an initial consultation with us, we're always available. You can reach us at 760-692-5700. And today we're going to talk about another obstacle in retirement, and this one pertains to divorce. I was kind of looking into kind of the divorce rates, and it was interesting. In 2022, from the National Center for Health Statistics, it shows that the number of marriages, there was over 2 million marriages in 2022, and the number of divorces, there's about 600 and almost 74,000 divorces in 2022. It's interesting because the number has been going down over the last few years, but there are still, unfortunately, a lot of divorces out there. And another interesting statistic I found was it's actually divorce rate is really among a lot of the younger adults aged 25 to 39. And the divorces usually end within the first 5 years. So kind of interesting. Obviously there's different marriages. Some last forever, some, they don't. I also found that based on first marriages, the divorce rate is about 40 to 50%. And on second marriages, it's 60 to 67%. So it was kind of interesting. I thought we'd start off with that, but kind of today we want to kind of focus a little bit more on the financial aspect of divorce.
Yeah, and we were kind of joking, but before the podcast this morning about getting divorced, but it's really a serious subject, and you really need to be, thinking about it financially, because oftentimes it's really emotional. And so meeting with your financial advisor or meeting with a tax advisor, I think, is one of the number one things that needs to happen if you're even considering divorce.
Well, it's interesting. We actually had a prospective client that came to us about 10 years ago, and she wanted to have a discussion and look at, she was thinking about divorce. She wasn't really sure yet, but she wanted to know kind of what was the financial impact to her if she were to get divorced. And so it's kind of interesting because you usually don't see that. Usually we see I'm either in divorce, or after, not the before, I even go down this path,
that's an interesting.
Yeah, it was kind of.
But it's financial planning. Seriously.
It's important to know because
seriously good financial planning there.
There's the financial aspects of all of this.
Well, because if you think about it, if you live in a community property state, then your assets will be divided 50-50, versus if you live in a common law state, it will be what they call an equitable division of property. And so you really need to consider how your retirement savings will be impacted, and oftentimes it will really be governed by state law.
Yeah. And so it's interesting because as you're, for the clients we've worked with, it's the emotional part of it, the change and lifestyle change and kind of career, what's next, but also the financial aspect of it. For retirement accounts, if there's a 401k plan, there's usually a quadro, which is the qualified domestic relation
order.
Or you have a 401k, which obviously you can move money. And usually you want to do rollovers. You don't want to take money out unless because there's tax consequences. But I know for quadros, usually they do waive some of that, the 10% penalty if you're under 59 and a half. So there's some things, kind of technicalities, and obviously you don't want to touch retirement assets, but if you're forced to, just kind of knowing, like you said, the tax implications.
Well, I thought it was really interesting when I was doing a little deeper reading on this subject, because when you look at qualified plans, so we're talking 401ks or TSP, thrift savings accounts, or IRAs, they all are governed a little bit by different rules. Yeah. And so if you're looking at the split of 401k funds, as you said, those are governed by the qualified domestic relations orders. So the court makes that decision. And the funds will transfer from one spouse to the other based on that order. And as you mentioned, the 10% penalty won't apply if you do take some of that money out. So clearly the best way would be to transfer 100%, because there are really three things to keep in mind when undergoing this sort of situation. Of course, there's the tax efficiency. So how much money do you already have in your income for the year? What's your salary before you think, okay, maybe I'll take some of this money out because I'm going to have some extra expenses.
Correct. Because when you take money out of these types of
you're
accounts,
going to be paying
federal and state taxes you have to
correct. So you're not going to be paying that 10% penalty, and oftentimes states will also have early distribution penalty, so you have to keep that in mind. California's is 2.5%. So the other thing to keep in mind is if you're rolling over or not rolling over all of the balance and you take some of it to cover, there is mandatory withholding of 20% federal and then whatever the applicable state rate is. So before taking distributions from retirement accounts, you might want to think about, or if you're splitting up retirement accounts from one spouse to the other, are there other assets that maybe you want to relinquish to keep your retirement funds intact? Because those funds are tax advantaged and they grow tax deferred. And if it's a Roth IRA or a Roth 401k, it's tax free. So you definitely want to be keeping those tax efficiencies in mind before you make the decisions as to who gets what.
Yeah, and then I think I've shared this in the past. We had a client that she ended up getting the house, which was great. She loved the home. She wanted the home. But she didn't have the income to keep up with the payments. Right. And so she eventually ended up having to sell the property and downsize and find something else. But the reality is, yes, sometimes you want that home, but is that the best place? Is that the best asset for you?
Absolutely, yeah. Keeping the family home, I've had so many clients where
it's hard because it's that emotional tie.
It really is.
I just want to stay here.
But can you afford it? And it's not just the payment, the mortgage. It's the taxes, the insurance, and insurance is going up all across the nation. What about repairs? What if you need a new roof? And so that's always making sure you're factoring that in before dividing up the assets. But back kind of to the other retirement assets, we've got thrift savings plans. Those are plans for federal government employees and uniformed service members, and those are actually governed by what's called an RBCO, which is a retirement benefits court order. So it's a little bit different than what happens to a 401k. So there's that. But then with an IRA, if you have IRAs or rollover IRAs, those are actually governed by different rules if you undergo divorce. So IRAs don't require quadros or qualified. They just, but the details have to be spelled out in your divorce decree, and then something has to be filed with a plan custodian. So I thought it was a little bit interesting. Nuances to all of it.
You want to make sure you kind of pay attention to the details, and then there's pensions and how do you divvy that up, and then the other thing that kind of comes up over time is Social Security benefits.
Yes.
So if you've been married over 10 years. Then you do have access to your spouse's benefit at 50%. But then if you remarry, then you don't have access to that. So those are typically things I don't think a lot of women understand or know about until later, but it's definitely something to consider.
And there are a few other rules when it comes to that Social Security that you're mentioning. So make sure that you're informing yourself about what that looks like to be able to claim your ex-spouse's Social Security benefits.
And when you should claim it.
And when you should claim it, exactly. But coming back to pensions, you touched on that briefly, but I thought that was interesting because pensions are different than 401ks or IRAs because 401ks are defined contribution, so you define how much you put in, whereas a pension is a defined benefit plan, so it's controlled and managed by the employer. So if you or your spouse are working for that pension, which is a defined amount that you're going to be getting later on, you really want to look to the plan details. And it's really important because you need to know what happens if one of the spouse dies or remarries. So because every pension plan is a little bit different.
And as we were talking about IRAs and all these different types of retirement accounts, for those that require beneficiaries, making sure that you update your beneficiaries after divorce, and that also includes life insurance. So if you have a life insurance policy, and you always want to make sure who's the beneficiary of these policies. So I think there's obviously there's the moving forward and kind of what's next, and I think that's where financial planning and retirement planning comes into play. Just because obviously there's a lot of change, but also once again making sure that if you're in a career change or if you have a lifestyle change, and what's that impact, and then also how much do you need to save for your retirement. So divorce can be costly, but also
it can be so costly.
I know, but it's also I think peace of mind too. Obviously knowing there's a plan, you can move forward. There's a strategy
and there are people who can walk with you and help you make good decisions. I think that it's really key to keep the tax planning piece in mind as well. If you're going through a divorce or thinking about a divorce, I have a situation unfortunately with a client who they did sell a home and didn't really think it all the way through with the tax planning piece. And one of the spouses, so the proceeds were split on the tax reporting documents to each spouse, so 50-50. So filing the tax return, and then all of a sudden, oh no, I have this huge tax liability, but wait, I didn't get the money from the sale of said asset. Ouch is right.
Yeah,
and so now we're, having to fight with the IRS, fight with the state, and go back and say, okay, look, I didn't actually receive this, $600,000 of proceeds from the sale of this asset. And so, and now they're saying, well, we don't care that the report, you have to change the reporting. And so going back to the court and having the court do the order or order more spousal support or so on. It's costly from all angles. So definitely you need to think about the tax planning piece that goes along with it.
Great. Yeah, so we have a lot of resources.
Yes.
There's a lot of tax planning, a lot of moving parts, but we're here to make it easy and be there with you along the way. We also do have some workshops coming up. So next week on April 25th, we have a Retirement by Design event, and that's going to be at 5:30. And then every month we're committed to doing live events, so happy to have you join us and participate. Once again, if you have any questions, you can reach us directly at 760-692-5700, and we appreciate you joining us today. And remember, Savvy up. Please stay tuned for important regulatory disclosures.
Savvy Women Wealth Management is an SEC registered investment advisor. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry and how we may be able to assist. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. As always, please remember investing involves risk and possible loss of principal capital. Tax considerations presented may not be appropriate for every individual circumstance. A tax professional should be consulted before making any decisions about your tax liability.